Get ready for market shockwaves. Intel is closing the gap with Oracle, with the market cap race heating up to just $8 billion. We break down how this semiconductor giant is surging past its competitor and what it means for the entire tech landscape right now. While maintaining a strong buy rating. We explore the underlying reasons driving this massive stock rally and the future outlook for the CPU market. And finally, we look at the bigger picture. Intel's potential chip deal with Apple, Elon Musk's plans for the Terafab project, and Trump's bold statements about beating China in the AI race. Don't miss a second of this explosive news. Stay locked in for the rest of the broadcast. American semiconductor giant Intel is closing in on Oracle in the market capitalization race, with the gap between the two technology companies narrowing to just over $8 billion. Based on market closing data from May 15, Intel held a valuation of approximately $546.67 billion, trailing Oracle's $554.93 billion by $8.26 billion. This positioning places Intel at rank 23 among the largest U.S. companies, directly behind Oracle at rank 22. This convergence reflects a dramatic resurgence for Intel, evidenced by its stock rallying nearly 200% year-to-date, with INTC shares trading around $108 at press time. A key catalyst for this rally was Intel's strong first quarter 2026 earnings report, where the company reported revenue of $13.6 billion, exceeding guidance by roughly $1.4 billion. The data center and AI segment revenue surged by 22% year-over-year, with AI-related businesses now constituting nearly 60% of total revenue and expanding 40% annually. Profitability is also improving, as adjusted gross margins climbed to about 41%, driven by stronger factory yields, tighter cost controls, and enhanced manufacturing execution. Furthermore, Intel's advanced 18A process node is reportedly progressing ahead of schedule, with improved yields anticipated to support higher margins and faster production ramps. Additional momentum stems from Intel's expanding foundry business and strategic partnerships. Reports of a preliminary chip-making agreement with Apple have fueled double-digit gains, signaling a major step toward bolstering U.S.-based manufacturing and reducing Apple's dependence on TSMC. Intel has also deepened its AI infrastructure collaborations with major players including Tesla, Alphabet, Microsoft, and Amazon. Meanwhile, Oracle continues to capitalize on robust demand for its cloud infrastructure and AI services. The company reported substantial contracted demand, with remaining performance obligations totaling $553 billion, underscoring hyperscale customer investments in AI infrastructure. While Oracle's cloud business continues its rapid growth and supports stronger guidance, ORCL shares have experienced modest pressure, falling about 1.8% year-to-date, trading at $192. Overall, the close market cap competition highlights shifting dynamics within the AI sector. Intel is gaining traction through renewed confidence in semiconductor manufacturing and AI hardware infrastructure, while Oracle remains a critical player in enterprise AI cloud spending. President Donald Trump has publicly reconsidered the equity negotiations with Intel, suggesting he should have demanded a larger government stake when the deal was finalized last August. This retrospective comment comes as Intel's stock price has seen a significant surge since the U.S. government secured a 9.9% equity position in the chipmaker in exchange for semiconductor investment support. The agreement marked a significant pivot in how the Trump administration engaged with critical technology infrastructure. Instead of relying solely on grants or subsidies, the administration insisted on acquiring an equity stake in Intel to bolster domestic chip production capabilities. At the time, this move generated considerable attention in Silicon Valley, drawing parallels to industrial policy approaches utilized by nations such as China and South Korea. What was initially viewed as an aggressive governmental intervention appears to have transformed into a lucrative investment for taxpayers. Intel's stock has rallied as the company accelerates its advanced manufacturing efforts and secures substantial contracts from both commercial and defense sectors. While the government's 9.9% position has appreciated in value, Trump's recent remarks indicate a belief that the administration missed an opportunity during the initial negotiations. Sources familiar with the discussions report that Trump stated to advisors, "We made a good deal, but I should have asked for more." This assessment aligns with a broader White House strategy characterized by treating technology investments transactionally, prioritizing concrete financial returns over reliance on soft power or voluntary cooperation from major technology firms. The equity arrangement arose from months of intense negotiations, driven by the urgent need to address vulnerabilities in U.S. semiconductor supply chains exposed by global shortages. The administration sought capital and government backing to expand domestic fabrication facilities, viewing the deal as a mechanism to secure potential taxpayer upside in the process. Market analysts have adjusted their price target for Intel, raising it to $140 from a previous estimate of $105, while maintaining a buy rating on the stock. This upward revision signals increased confidence among market watchers regarding Intel's future performance and prospects. The adjustment reflects a more optimistic outlook on the company's trajectory, suggesting that analysts believe the stock has more upside potential than previously assessed. This change in valuation metrics is significant for investors tracking the semiconductor industry, as it directly impacts the perceived value of Intel's shares. U.S. President Donald Trump expressed regret over a negotiation concerning a stake in chipmaker Intel, stating he should have sought a larger ownership share. Speaking to Fortune, Trump revealed that he had initially asked for 10% ownership for free of the company, a proposition that Intel's CEO Lip-Bu Tan reportedly accepted. Trump later asserted that if he had been in office, he would have protected Intel with tariffs, predicting it would become the biggest company in the world right now, amid the influx of chips from China. He further claimed that such protection would have secured all that business and prevented reliance on Taiwan Semiconductor Manufacturing Co., whose market capitalization stands at $1.84 trillion, compared to Intel's $547 billion. This commentary comes as Intel's stock has surged over 300% following government actions. In August, the U.S. Commerce Secretary announced the government had taken a stake in the chipmaker, converting unspent grants from the CHIPS Act and other awards into equity. The company's recent momentum is fueled by significant industry developments. Reports indicate a preliminary agreement between Apple and Intel for Intel to manufacture chips for Apple devices, while Tesla CEO Elon Musk has cited Intel's future chips as essential for his $119 billion terafab project. Analysts point to a broader market shift favoring Intel. Bank of America forecasts the CPU market could more than double by 2030, and NVIDIA has identified CPUs as the critical bottleneck for the artificial intelligence era, with Intel's CEO Tan noting that demand for its data center CPUs currently outstrips supply. This renewed demand has coincided with Intel's strong performance, marking April as the best month in the company's 55-year Nasdaq history.